Amin Reina here from Sage Investors, and I'm going to walk you through the mind map, the thought process I went through that led me ultimately to the decision to buy shares in Big Lots. Now, for basically every time I'm looking at a stock, when I'm trying to evaluate a stock, there's some key questions I always ask myself, and I'm basically going to walk you through those questions and try to answer them here, and show you how it ultimately led to my decision to buy stock in Big Lots. So, first question I always ask myself when I'm looking at a company is what do they do? What's so special about them? What do they sell? What products and services do they sell? When I look at Big Lots, essentially what they are is they're essentially a discount retailer, and they're a little bit different in the sense that they just don't sell cheap goods. It's what makes them a little bit different is traditionally is the way they source their goods, and what they usually have done is basically scoured the land for discontinued products, discontinued companies have excess inventory or overstocked, and they essentially buy that excess inventory and buy inventory that they think that they can sell at a discount and at a competitive price to consumers. And so what they do is, and that's kind of the nature of what they do, and what that sort of separates them from maybe traditionally a Walmart or anything. They do sell traditional goods, and they have now kind of evolved into selling traditional type goods. They have actually just recently have started refitting their stores to include freezers. So they're getting more into the grocery food aspect too, side of the retail sector too. So that's what they do. Essentially, they're a discount retailer. Now, who do they compete with? As I said, the discount retail space is just really, really ultra competitive. There's a lot of big time players, and obviously the big ones are Walmart, Target, are the big ones, are the big boys. But then you have other players like up here we have a company called Giant Tiger, Dollarama, Dollar Tree. It's a big one. Dollar General. There's lots of dollar store kind of retailers out there, and of course we can't forget about the big and mighty Amazon too. They're the big players, especially with respect to the online side. The big thing about this space is it's ultra competitive, and it's a low margin business. So you got to really make it up on volume, and so that's what makes this space, this whole discount retailer space, competitive. Who are their customers? Who are predominantly the main customers that would shop at a Big Lots? Well, they are people they skew towards a lower income bracket. They're very price sensitive, in the sense that because they have a lower income bracket, they want to make their dollar, whatever limited amount of money that they have, go farther. So they're very price sensitive. They're very price conscious. Just simple things in their life, like for example, gas prices or rent, really has an impact on how their ability to consume. And so, what draws lower income people to places like Big Lots is just that value proposition. The value in terms of their dollar, goes farther. They can buy more of the staples and necessities. It may be a lower quality because it's cheap, but it gets them through. It sustains them from that side of it. So because of that, the other question I ask myself is, will people, it's great, people will go to a Big Lots and buy stuff, but will they go again and again and again? Because ultimately we want to invest in businesses that can generate consistent, meaningful cash flow. And so from the perspective of the demographic that they are drawing in, and the fact of the matter is, our society is just becoming much more polarized in the sense we're having more people in lower income and more people with higher income. That whole hollowing out of the middle class, that has been actually a boon for a company like Big Lots and discount retail as a whole. So what else about Big Lots? Well, the question we also have to ask ourselves as investors is, do they make money? Is this a profitable business? This is a business that's generating tangible wealth for its shareholders. And so when I looked at some of the numbers, and one of the things that kind of got me into, as I said, this is the second time I've actually owned Big Lots. And the first time I owned it, what drew it to me was just their management's consistent ability to generate consistent economic profit, high returns on invested capital that were greater than their cost of capital. And so when I was diving back into stock, I started looking at their numbers. And so when I looked at their return on invested capital over the last 3 years, it's come in between 18 and 26%. Their cost of capital is coming in around 10%. So this is a company that's creating tangible economic profit. It's creating real organic wealth for its shareholders. And that's ultimately a core feature that we want to find out. We want to invest in businesses that can generate strong economic profit, because ultimately, over at some point in time, the stock market is going to reward companies and puts premium on companies that can generate positive, high returns on invested capital and high economic profit. What's interesting about Big Lots too is they kind of have had a really good run the last while. They were at a point where they had 12 straight quarters of either break even or positive profits. And so that just recently stopped in 2017. The company's been doing really well in terms of performance. It has benefited from lower oil. The recent dive in oil prices has kind of drawn more people to have more income in their pockets and has allowed them to spend more at their stores. The flip side of it is revenue growth is pretty much has been it's single digits. This is not a this is not a growth stock, and so this is not a growth company, but it's a company that seems to generate really high levels of return on invested capital. And then, again, considering the fact that this is a low margin business, for the fact that these guys are generating such high returns on invested capital is pretty impressive, and they've been doing it very consistently over long periods of time and through various different economic cycles. So that's kind of a cool thing with Big Lots in that sense. So this is a company that's tangibly creating money. So we're interested. So that keeps us interested. So the next question I'll ask then is, what's the financial strength of the company? Is this a company that's going to be around for a long time? So this really involves taking a quick look at their balance sheet. And so a couple of things when I look at the balance sheet I want to look at is their liquidity from a liquidity perspective. From a liquidity perspective, their current ratio, let's get that back. Their current ratio, is about 1.5. So they have about 1.5 times 1.5 more current assets than current liabilities. So that means this company has more than enough liquidity to sustain itself on a day-to-day basis. One of the things I also noticed, though, was it had a pretty high inventory, and I think this is maybe one of the reasons why the stock has been kind of tracking down in the last while, is that their inventory levels have been a bit high. And ultimately, we don't want to see a company carrying high inventory, because then it makes it harder for them to get rid of it. And then if they do have to get rid of it, they're going to pay a lower cost. They're going to have to get rid of a lower cost, which is kind of ironic because Big Lots is in the business of taking inventory off other people's hands. And so here they are actually carrying a higher inventory level, and which can be considered a bit of a risk, because if other people, if they can't sell it, then chances are they're not going to be able to find people who are going to want to buy take their inventory down, because it's already somebody else's scraps in a sense. So there is a bit of a risk there in terms of how they manage that inventory level. When I looked at their debt level, the debt equity ratio of debt to equity comes in at about 0.3, which is pretty manageable. They have a manageable amount of debt. Quality of the company's assets, they have 0 intangible assets. which means, the quality of the assets in the company are very, very high and very, very, very strong. So when I look at this, is a very clean balance sheet. It's a very clean, easy to understand company. There's not a lot of kind of accounting mumbo jumbo going on to it. It's a pretty straight up kind of operation, and management has been very diligent in running their business and managing their capital. It appears to be in that, and they've been doing it consistently for a long period of time. Like anything, so far the story seems to be pretty interesting, but there's always risks when you're investing in companies, investing in stocks. So what are the risks that could potentially threaten this really good run that the company's been on? So one threat is economic cycles, in the sense that if the price of goods, like as I said, oil prices kind of go up and people's disposable income is threatened, is reduced, then chances are they're not going to have as much money to spend. And especially for people who are in the low income bracket, that can be very, very tenuous. And so the stage of economic cycle can be quite a risk factor. If the economy goes into a sustained recession, that could put less money in people's pockets. They'll be less likely to buy things, and especially they might want to sacrifice some core necessities and staples that they have. So economic cycles is a risk there. Another one, I guess, when you're thinking about it at a first level, what could threaten Big Lots is the whole online concept, growing online disruption that's taking place, led by Amazon. But when I think about what Big Lots is all about, as I said, their primary customers are people with lower income. They're very price sensitive, price conscious. Chances are they don't have a lot of the wonderful technology gadgets. Like, chances are, I don't know if they would have, they might have smartphones, but they may not have smartphones with data plans. They might have very, very minimal cell phone capabilities on their smartphones, and as such, they may not be drawn into buying something from an Amazon or a Walmart because it's just too price prohibitive for them to do it. So I could see in a way, potentially them being insulated from the whole online kind of threat out there, because I think the people that are going to a Big Lots or shopping at a Big Lots don't have a lot of as much money, and they just are going to be compelled to have these kind of technological gadgets out there to help them do e-commerce and buy things online or anything like that. For them, it's just cheaper to just go to the store and buy directly from the store and get the things that they actually need. So there are risks associated, just like any other retail place, low margin, the Amazon threat. Yeah, but again, it seems like Big Lots feels like it's a little bit unique in that it can probably withstand some of these pressures. So that leads us to the final question that I always ask after I've kind of gone through everything. I've looked at the kind of the fundamentals of the business. We've looked at some of the numbers, the profitability, the financial position, some of the threats around it. Ultimately, it comes down to, if at this point I'm really interested in the stock, I got to find out, is the stock cheap? Is it worth buying the stock right now? Or maybe do I need to park it on my list somewhere and jump back in maybe if the price should pull back? So when I looked at the stock appears to be pretty cheap right now. If you looked at it on a relative basis, it's trading at a forward PE of 9.5, which is much lower than other similar type competitors out there. If you're looking on a valuation perspective, the stock seems to be, from what models that I've seen out there, trading in, have a valuation attached to it between $41 and $60. Currently, the stock was trading in the 60s, but now, the time that I've started looking at the stock, it was trading as low as $43. So clearly, like it's gone down in price. I think the stock is cheap, but I wonder, is it out of favor right now by Wall Street, by investors who are interesting? And if that's the case, that's kind of piques my interest, because that's what I love to do. That's what I'm constantly looking for, is companies that are generating strong returns on invested capital but are out of favor, because chances are if they're out of favor, then the stock's going to be trading at a bit of a discount. And so right now I could potentially see, when I looked at the stock, it was trading around $43. And if the stock really has a valuation, in the 50s or even in the low 60s, then there's definitely good upside here. I thought, at least, there was a bit of a good upside here to make a bit of cash on this if I bought and hold this stock. So at the end of the day, I kind of looked at a couple of things. One of the things was some themes. One of the themes I've been trying to get into my portfolio and trying to get exposure into is sort of this whole extreme retail. And I talked earlier about sort of this polarization between luxury, high income, and discounted retail. And so to me, I think Big Lots Big Lots kind of fits that whole discounted retail type thing. And the fact that right now the economy is going good right now, a little bit better. At some point, the economy is going to slow down. And so I think at some point, if the economy were to slow down, then you go into a recession, I think places like discounted retailers, I think could be in a really good position to benefit from that, because people are just going to try to get more value out of their dollar, and are willing to and are going to be a lot more price conscious. And sort of Big Lots seems to be that kind of company that will fit that need down the road. So this is kind of like, trying to get I kind of looked at it as just a way for me to kind of get ahead and in a way hedge myself, I guess, if the economy and things in the markets were to slow down. So when I factor, so at the end of the day, to me, it seems like a really solid, well-run, well-managed company. It's generating positive economic profit. It's got a really strong balance sheet. So that's from the financial side. It looks really great. It's definitely in an area type of retail space, which, even though it's competitive, I think it's kind of insulating itself from potential threats like Amazon and Walmart and Target and the online side of it. It's a nice kind of, it seems like it's a bit of a nice niche kind of little stock, retail stock, that's just, you can just kind of, is positioned kind of in between all the stuff going on with online, and then also the whole, collapse of sort of the mid-level retail space. So when I factored all these elements together, I thought, and the fact that the stock was down from the 60s down into the 40s, I thought this was probably a good entry point to start building a position and owning the stock. So at the end of the day, after going through all this stuff, my decision came towards buying. And so that's what I did. I bought a little small position, and I bought it in the 43 range too. So that's my analysis of my decision to buy Big Lots. If you want some more information about other companies that I've been analyzing, you can follow me through my website, sageinvestors.ca, or you can find me on Twitter. My handle is @sageinvestors. Thank you very much again. This is Amin Reina from Sage Investors.